Hello, aspirants! Welcome back to another Rungta IAS Academy Explainer. Today, we're diving straight into a massively high-yield topic for your UPSC GS Paper 2 mains. We're talking about the 16th Finance Commission, and specifically, that constant tug-of-war between federal equity and economic efficiency. For GS2, having absolute conceptual clarity on this isn't just nice to have, it's practically non-negotiable if you want those top marks.
Absolutely, sir. And aspirants, right off the bat, let me throw the central dilemma of Indian fiscal federalism directly at you. Put yourselves in the shoes of an administrator for a second. How exactly do you balance rewarding those economically efficient, high-performing states while still honoring the constitutional mandate to ensure equity and uplift the fiscally weaker ones? Keep that analytical engine running, because this exact question is going to form the backbone of everything we discuss today.
Right, so before we get completely lost in the data weeds, let's do a super quick conceptual refresher. You've got to be crystal clear on these two terms. Vertical devolution, that's basically taking the gross tax revenues and transferring them straight from the center down to the states as a whole. Horizontal devolution, though, is how that combined state pool is sliced up like a pie and distributed among the individual states. And that slice is based on a specific and, frankly, highly debated formula.
Exactly. And speaking of that vertical slice, the 16th Finance Commission kept the state's share locked in at exactly 41%. This is a crucial data point to remember. A lot of states were pushing hard, really demanding a 50% share, but the commission held its ground at 41%. Now, to truly understand why these states are clamoring for more funds, we need to look at the immense pressure their budgets are under right now.
Oh, absolutely. Their fiscal space is shrinking fast, and this is perfect fodder for your mains answers. First off, jot down the keyword unshared pool. Basically, cesses and surcharges now eat up over 15% of gross tax revenues, and the center doesn't share a single rupee of that with the states. Throw in the structural bottlenecks after GST rationalization, the fact that states are now footing 40% of the bill for NREGA, plus the total abolition of revenue deficit and state-specific grants, while it's a really tight squeeze.
Which brings us to the real fireworks, horizontal devolution. Look at the vastly different trajectories here. Under the 15th Finance Commission, major beneficiary states, think Bihar, Madhya Pradesh, UP, and West Bengal, saw their combined piece of the pie swell to 51%. Meanwhile, your historically better-performing southern states, Andhra Pradesh, Karnataka, Kerala, and Tamil Nadu, their combined share actually dropped to just 15.8%. That is a massive, gaping 35.2% divide.
So, the critical analytical angle you need to bring to your exam is this. Have these massive equity-driven transfers actually led to better public service delivery across the board? Well, looking at per capita spending, the stark reality is no. Take 2022-23. Bihar spent a mere 937 rupees per person on health. Contrast that with Arunachal Pradesh spending over 10,000 rupees. Or look at elementary education. Bihar's per-student spending was around 20,000 rupees, while Sikkim spent a whopping 1.3 lakh rupees per student. The takeaway? Simply throwing fiscal transfers at the problem hasn't bridged the gap on its own.
Right. So let's crack open the 16th Finance Commission's actual formula and see where the weights lie. Notice that huge chunk for income distance? It sits at 42.5%. When you add up all these criteria, the scale is still heavily tilted toward equity, commanding a solid 70% overall weight. Efficiency metrics, they're left with just 30%. It's an adjustment from the 15th Commission, sure, but a very modest one.
Now, aspirants, please grab your pens and underline this next phrase. It's a high-value analytical keyword, the square root transformation. So, the Commission did introduce a state's GSDP contribution with a 10% weight, but instead of just using the actual GSDP numbers, they threw a massive mathematical curveball. They applied a square root transformation. What does that mean? It basically neutralized the advantage of economically stronger states. Take Maharashtra. Its actual GSDP share was 14.23%, but after applying this formula, boom, it plummeted to just 8.31%.
Let's put our economist hats on for a second and look at the what-ifs. If the Commission had just stuck to the actual GSDP with that 10% weight, or even used an equal weighting scheme across all criteria, the shares for states like Maharashtra, Karnataka, and Tamil Nadu would have surged. Simply dropping that square root math and using actual economic output would have completely redrawn the devolution map for these high-performing states.
To pull those abstract percentages down to earth, let's talk hard cash. 2.49 lakh crore rupees. That staggering amount is the estimated extra vertical transfer Maharashtra alone would have pocketed over the award period if an actual GSD framework was used instead of that square root trick. We are talking nearly 50,000 crore rupees every single year. It's a harsh reminder of exactly how much these dry mathematical formulas dictate actual governance on the ground.
So the big question for your GS2 mains, how do you conclude this beautifully? You've got to offer a balanced, forward-looking way forward. You can advise that future commissions really need to shift their focus toward actual fiscal capacity and tangible outcome indicators, moving away from such a heavy reliance on non-physical demographic metrics. And here is your golden ticket to impress the examiner. Suggest they adopt rigorous, data-driven approaches using advanced statistical models like principal component analysis to assign these critical weights impartially. Drop that term in your conclusion, and you are golden.
Finally, let's fast forward a bit to your UPSC personality test. Picture this. The board looks at you and asks, how should future finance commissions balance political representation with economic efficiency? It's tricky, right? Because unlike Australia or China, Indian states with high parliamentary representation aren't always your economic powerhouses. I really want you to chew on this impartial balance. Think about how we reward stellar performance without abandoning our most vulnerable populations. Keep pondering that, keep analyzing, and we will catch you in the next explainer.